Welcome to Barchart series of educational webinars. Today's session, Unveiling the Power of the Naked Put Option Strategy. Now, the Naked Put Options Strategy is one of the simplest option strategies, yet its versatility makes it a mainstay for options traders. Now, what if I asked you, would you be comfortable buying Carvana at $25? I think most of us would agree yes. But there's no guarantee that Carvana would get back to $25. So let's say now assume that you're still willing to purchase Carvana at $25 for the next, let's say, 30 plus days. Selling a $25 strike put could return you a 7% return on that potential investment opportunity. There's a $25 put, and that potentially could return 7%. In other words, you get paid to wait. Hello everyone, my name is John Rowland, Barchart Senior Market Strategist, and the Naked Put strategy is one of my favorite option strategies. And that's because depending on how I design it, for instance, like the example I just showed you, it allows me to generate income in stocks that I don't own, that I believe are still in trending or trending higher, or, as I will show you later, selling a put closer to current price in the hopes that the purchaser of the put will exercise their right to sell me the stock at the strike price of my choosing. But that purchaser has paid a premium for that right, and thereby discounting my stock price. Now, either income generating or discounting the purchase price of a stock, the Naked Put strategy is an effective way to use options to trade equities where you have a slightly bullish outlook or stocks that you're willing to own but are waiting patiently for your price. So stick around as we explore the Naked Put strategy. Now, before we jump into that, please welcome my partner and our moderator, Barchart's project director, Gene Baker. Hello, Gene.
Good afternoon, John. How are you?
I'm doing great. How are you doing?
Oh, good. We got the boomer thunder showers going through Chicago today.
Ooh.
Yeah, lots of storms going on here, but
well, I know
nice.
The corn farmers are going to be happy because they've been dying out there, right? You guys can have a bit of a mini drought, right?
Right. I was just going to say that we've got a lot of farmland out here that's hopefully going to turn a little bit greener than it has been.
The only problem is when you get like these kind of these rain days is like down here, then my grass like doubles in a day and I got to cut my grass 2 times in a week. That's not a good thing for me, at least.
No.
But we wanted rain for the farmers, so I'm happy for that.
That's right.
All right, Gene, ready to get started?
Yes, we are. Let's get going.
All right. Just remember today's session is for educational purposes only, and that decisions to buy, sell, hold, or trade securities, commodities, or any other investment involves risk and investment made and based on the advice of qualified financial professionals. Now, I will add that options trading is not for everyone. It's important that you understand risk and the potential loss of principal before trading any option strategy. And under no circumstances shall we be liable for any loss or damages that you or anyone incurs as a result of any trading investment activity that you or anyone else engages in based on information or material that you receive through barchart.com and our services. Okay, so before we get started, I do want to briefly discuss that there are 2 variables to the Naked Put strategy. And the one is that there's something called cash secure. Now, depending on the type of account you have with your broker is going to require that you put up cash to cover the cost to purchase the shares in the event that the put that you sold is assigned. In other words, exercised. Now, those monies are held in escrow and they're yours, and they will be returned to you if you close out the option position or the option expires worthless. Now, the other part of this coin is that you could sell puts in a margin account or on margin. Now, this is a little bit more advanced and it's a different type of account. And the collateral that you put up is a fraction of what you would have to put up if you were in a cash secured situation. And this will increase your leverage and it also will increase your risk. Now, since the calculations on the naked put page, the defaults are based on a cash secured, we're going to concentrate on that. But just know this, regardless of the type of account that you have, selling puts will require some type of collateral. Okay, so what is the naked put strategy? Well, it's really an investment strategy that's very similar to a cover call. What do I mean by that? Well, the profit profile or the risk profile is very similar to the cover call. Now, using a naked put strategy, you're going to sell a put option on a stock that you don't own, and you're going to earn premium income if that option expires worthless. Now, there is a little bit more risk than you would on a cover call. That would be because you are now obligated, selling that put, you are obligated to buy the underlying stock if the price of the stock falls below your stock strike price. I got tongue-tied today. And that put is exercised. Now, this term naked is because you're going to be obligated to purchase these shares if you get exercised. Now, I just want you also to remember that one options contract represents 100 shares. And that our page, our naked put page, is designed, or it's initially sorted by a descending potential return. Now, we're going to get a little bit deeper into that in a moment, but that's how the page is sorted. Now, inside the strategy itself, as I mentioned, there are really two purposes or goals. The first, the one that I just showed you, was the income generation. And the second is ownership by lowering our acquisition costs. So as I walk through these inputs in the naked put page, I'm going to distinguish between the two different strategies and the results that we want to kind of look for. All right. So in case you're not familiar where it is, here's options, advanced groupings. There it is, naked puts. And you can see right now that the screener is generating over 665. So we'll talk about how to narrow this down a little bit. All right. So first of all, one of the things that I'm going to point out here is first on this little X here is if I open that up, this is going to give me kind of like this Reader's Digest snapshot of some very critical information. Now, not all the information that can be found in here is pertinent to our strategy, but there are some elements that I think that are important. So the first one is obviously a chart, which is nice to look at because, you know, remember the naked put strategy is really designed for a slightly bullish or uptrending market. And so if you see a stock or a trade that you like, you can quickly look at the chart and say, oh, you know, this one might not be a great example because, you know, this stock certainly does not look like it's in an uptrend. Matter of fact, if I was trading this stock, I'd be thinking about calling the heart doctor, but that is something to be said later. The other thing here is our opinion page. And our opinion page Barchart provides really looks at technical indicators at a variety of time frames, short, medium, and long term. Again, because we're looking at a naked put strategy, we probably want to look for those candidates that have at least 2 out of the 3 indicators showing us a buy signal or giving us a buy recommendation. So, here's AMC. Now, let's go, for instance, to Carvana. And, what do we see? A quick snapshot of a chart, right? I mean, nice uptrending market. This would be a great candidate for the strategy. In the opinion, here you see that all the different variety of time frames are all indicating a bullish scenario. So that would be a better candidate. The other page that I kind of like to look at is the technical pages. And there are 3 pieces of information here that I'm going to use. One is first is the moving average. Now, why do I want to know the moving average? Well, because when I start doing my analysis in terms of strikes and break even, I want to find some technical support. In other words, there's this belief or consistency to moving averages that stocks or equities that are in an uptrend or that are moving higher tend to stay above, at or above their moving averages. So they act as levels of support. So if I can design my trade where I have a moving average in front of my strike and my break even, that is a sign of strength of a price action. In other words, I don't fear that price is going to fall through me because I have this technical indicator in front of me. Something else you look at is average true range. And I don't know if I'm going to go get deep into this one, but we can use an average true range as a measuring stick of how much price can move on any given day. And this also can give me kind of an idea of, let's say I'm looking for a better price in terms of my bid price, is the price that I'm going to look for, is it relative to today's price action, or I'm going to have to wait a number of days based on how much the stock moves up or down in a range of price during one particular day. And then the other one is the 20-day historical volatility. Now, again, this is more of a relative measurement. Again, we're gonna look at more of the implied volatility, but looking at implied volatility as it relates to historical volatility will be an important assessment for us. And this will make a little bit more sense as we get a little bit deeper. So we have price, and what is this? This is the price of the equity that we're thinking about trading, the strike of the put that we are thinking about selling, and then here's moneyness. Now, moneyness represents how far we are the current price to the strike price. And red represents that the strike is below the current price. In other words, out of the money. And if I change my parameters to in the money, then you'll notice that our moneyness are green or positive. And this represents that the strike price is above the current price. So we'll go a little bit deeper into that as well. So if I'm looking at income, right, and I'm not necessarily want to own a stock, right? I just want to play out this directional outcome, an uptrend, or maybe a market that has been uptrending and now is trading sideways. The general rule here, and again, I'm going to give you some general rules for today's session. And none of these are cut in stone. They're just kind of general rules for you. I want to look for a moneyness that is greater than 10%. Now, the theory here is this is basically the theory of price movement, impulses and corrections, right? So a typical correction is about 10%. So if I'm looking to do an income type generating trade, I don't want the stock to come back to me. I don't want to get exercise. I just want to collect that premium. So I want to be outside of what would be a normal correction in the market, and that would be 10%. Now, if I'm thinking about entering the trade in terms of acquisition, right? I want to buy the stock. Well, then I want to be inside of 10%. I want to be inside of that correction phase because I want to get exercise. I want that option to be exercised so that I can take ownership of that stock. Now, just remember that, again, the closer we get to at the money, the closer we get to current price, or maybe even slightly in the money if I was looking for an acquisition, that the closer we are to the current price increases the probability that that put would be assigned. So if I don't want to be assigned, I want to be farther away and a greater moneyness. If I do want to be assigned, I want to be a lot closer. Now, expiration date is just the expiration date of the option. Now, under our main view, this is our main page, but if you go under filter view, if you don't know how many days that is until expiration, there is a filter days to expiration. And you can see that on this first one, it was 37 days. And that would represent the August monthly expiration. And this is going to be important for us because when we start doing potential return, we want to know how many days we have until expiration. And then we're going to use that to kind of line up how much expected returns that we want to try to gain. The bid is the price of the put that was going to be sold. Now, we don't necessarily have to take the bid price. It's just that the page here is calculating based on the bid price. We could set about in a price of our choosing, and that might be dependent on how much credit we want to take in or how much credit we want to receive and how that relates to the credit value as it determines our break even, which we're going to look at next, and or where that price, that break even price, falls technically on our chart, or the amount of credit that I'm going to receive as it relates to our potential return. Maybe I want a greater potential return, so I want a higher bid price. The bid percentage is basically just the distance current price is to the break even. Now, again, this is a relative number. The greater the percentage, the further the price has to travel to reach our break even, and the less likely we are to be assigned. Volume and open interest. Well, volume and open interest will give us some good information. Now, the default filters, we're going to look at those a little bit later, do have some current certain thresholds that we want to look for in terms of a minimum amount of volume or open interest that could be modified. But my take is usually this, that I like to see high volume or at least a large percent of volume to open interest. This tells me that the put is active and potentially that buyers are inflating the premiums of the puts. Now, open interest gives me more of a cautionary tale. The lower the open interest tells me that that put is not very active and that there could be a wide bid ask. There might be not a lot of liquidity, and this could present a problem if I'm trying to exit a trade. The delta can help us in several ways. First, like moneyness, it gives us a perspective of distance from current price. If you're in income hunting, then we're going to concentrate on deltas that are below 0.25 or 0.20. In other words, 25 deltas or 20 deltas out of the money. That's what we want. And this is telling me that there is a 1 in 4 or a 1 in 5 chance that price will expire at the strike. More likely it's not than it is. If I'm in the acquisition phase, then I'm probably going to look at deltas that are closer to 35 or 0.35 or greater. In other words, a 1 in 3 chance that price will come to that strike price at expiration. Now, the second part that delta can help us with is we can use delta as a value to eyeball the price change of our put with every dollar change in our underlying stock. Now, in other words, if I want a higher bid price to lower my break-even price or increase my potential return, how far does the stock price need to fall in order for me to receive my offer? So let's see if we can find a good example here. Just kind of gazing through these. I looked at a couple this morning, and market's changing. All right, well, let's just take this Carvana one because we already kind of looked at Carvana. So here's a $35 put, and the bid here is $5. Let's say, $5 is not enough for me, or I wanted to try to get my break even down to, let's say, $29, or maybe a little bit lower than that. I want to get $6, right? I'm going to collect $6. Well, how far will Carvana have to fall in price in order for this put value to go up, right? Remember, there's an inverse relationship here. So we can see that the delta here is 27.9. Let's just round it up and say it's 28. So that means that for every dollar move in Carvana moves down, the put will increase by 28 cents. So if I want to get to closer to $6, well, then I need Carvana's price to fall by, about $4 if I was looking to do this trade today in order to get that $6. Now, remember that assessment we said about on our technical analysis. Well, we can see that for Carvana, the average true range is only $3.28, which means that there's a very low probability that if I was going to try to do this trade today, I wouldn't be able to get this trade because it's more likely that Carvana is going to stay in this range around $3.28. And that's not directional, that's just range. So it can give me a little bit of an idea as what I'm trying to achieve. Is it doable for today? In this case, it would not be doable. All right, so applied volatility, or IV. Now, this is a value, just like a lot of other options analysis, it's relative. But the general rule here is that the higher the relative implied volatility, the higher the probability that the put will finish in the money. Let me say that again. The higher the probability that the put will finish in the money, but also higher premiums to be collected potentially. So implied volatility, a high implied volatility is good, but like all things, too much of a good thing is not good. So, again, it's just from my own personal experiences, I typically start my search between an implied volatility of somewhere between 50 and 100%. And then if I want to expand my candidates, I'm more likely to expand it to the lower end of that range than I am to the higher end of that range, because now I'm going to be, more likely that if I'm looking at a strike combination, that if I'm looking at a 200 or 300% probability, implied volatility, then that is putting me at risk if I don't want to take ownership of that stock. Our potential return. Now, this is going to be probably one of the most important inputs we're going to look at. So let me pull up the help page again. And did I pass it up? Yeah, I think I did. Hang on, here we go. There we go. So our potential return is the bid price divided by the strike minus the bid price times 100. Now, in other words, what this is that is the premium that we're going to collect divided by the collateral that we put out. Remember, this is a cash secured design, right? So how much cash are we going to have to put up as collateral versus what is the premium I'm going to take, and then that'll give me a yield return. Again, if I'm conservative and I'm only looking for income, then the general rule is that we want to find a range of somewhere between 1 to 2%, and that's a minimum, I think is a good minimum to start with, for every 30 days to expiration. Now, if we annualize that, in other words, we times it by 12, we analyze that result over a whole year, then that annualized rate that I want to look for is somewhere between 12 and 24%. Now, if I want to purchase through entry on a discount, right, then the potential return represents my discount coupon. In other words, how much do I want my stock price to be discounted in order for me to take that trade? How much savings do I want to get? And then this value really becomes relative to the trader in terms of, how badly they want the stock, how much of a discount they want. Again, for me, I like to look for discounts of about 5 to 10% of at the money strikes. So let me show you an example of that. And again, I was looking at this morning. One of the examples I look at was right at the top, and now you don't even see it. Okay, so here we go. I think it's this one. So here is, what's this, Palantir? Yeah. So, we have a moneyness of negative 9 inside of that 10%, inside of that correction, right? And this one is the August expiration, and I'm going to take in, looks like about 81 cents, and that is going to give me, a break even around $14.19. And that credit that I'm going to receive is going to discount that $15 put by 5%, or 5.7%. So this would be a trade that if I was willing to buy Palantir at around $15, I'm going to get a 5.7% discount if the owner of this put exercises me on this $15 put. Now we're going to look at some other things like where I might want to set my break even to make sure that I'm not exposed to risk. But you can get the general idea here is that I want to make sure that I get a good discount based on, the strike price. All right, so let's do this. So this kind of brings us to our next step in our process. Let's start putting these pieces together in order to help us rank or evaluate setups and strikes. So let's go back to our Carvana example, and I think there was one, here it is. Here's one that just came, it's at the top of the list based on our return here. And you can see the current price of Carvana is $42. The strike here is $35. The moneyness is 13.9, again, outside of 10%. So probably a better income trade. And we're going to take in $5.05, and that return over the next, let's say, I think it's 37 days, potentially would be 17.9%. Now, how did I get that value? How did I get that percent in return? Well, if I just get a calculator, and I just wanted to show you this, $5.05, whoops, divided by the break-even price, remember that. Our break-even price in this case would be $29.95. Times our 100, There's your 5 points. Did I do that right? Yeah, I think so. 5.6%. I think I used one too many decimals in the example. Something's wrong here. I didn't. That does not look right. Yeah, 29. Let's do that again. Should be a better price. I think I used it wrong. There we go, 16.8%. All right. And that would be our 16.9% on that trade. All right, so then again at this point, now let's go back to our chart. So here is Carvana. Here's our chart that we looked at, and I just showed you the $35 put. So one of the next things we want to do is we want to start looking at combinations in terms of where the puts are, and also let's see if we can find some technical evidence or technical strength that'll allow us to say, hey, where do I think that price will not go to? Okay. In other words, I want to find an area where I think price is going to stay above. Again, remember, I'm an income trader. And so that $35 put does look like it is relatively close to current price. Where did we say that we thought we would be more comfortable saying that we didn't know if price would get back there, or where we believe that there is some technical support? Certainly looks like it's around the $25. So another thing we can start doing is look at some very easy technical analysis. And one of the most simplest ones is moving averages. So here I have a template that it's already created, and it has the 20, 50, 100-day, and 200-day moving average. And you can see that our 20-day moving averages today is at 26.77. In other words, it's above this $25 strike. Now the 50-day moving average is a little bit below it, right? So maybe I might want to look for a strike price that's somewhere inside of there. But the screener gave me the 35. It doesn't mean I have to take what the screener's telling me. I've done this technical analysis, and now I'm going to say, well, maybe what I'll do is I'm going to look for a $25 strike. So what can I do? Well, down here under options, under Carvana, and you'll find this on all the stocks, is their naked put. Now remember, we were looking at the August monthly with 37 days out. And here you can see the $25 put, right, has a moneyness of minus 39.6. And again, think about this in terms of how far price has to travel in order to exercise us a large distance, and probably a very safe value in terms that it's not going to happen. I'm going to take it at $1.66. That's going to give me a break even of $23.34. So let's look at that. $23.46 puts me right inside of this window of where I believe price should at least hold, and also below my 20-day moving average. Now, what's my potential return? Well, I'm going to get 7.1% for the next 37 days. Well, I think that's a pretty good return, right? In terms of how much capital I'm going to put out and what I'm going to get a return in it. Again, what was one of the other technicals that we could look at? Well, we could say, well, let's look at this in terms of delta, right? We said that, if I'm going to look for income generating deltas, then I want to be below that 0.20 or 0.25. What's my delta here? It's 0.11. So this is really telling me there's a 1 in 10% chance that Carvana stock price is going to be at $25 at expiration. That's a low probability. a low probability event that's giving me almost 7% return on my money. I think most of us would be happy to do a trade like this. All right, so the other thing that I like to do, let's go back to our naked put screener. And we talked about these settings that are the default settings, and you can adjust these accordingly, right? You could change the date of expiration. You could look at maybe say weekly expirations, not monthlies. You could raise or lower the volume or the open interest thresholds. And then again, notice that our default for our moneyness is out of the money. In other words, this is driving a more income generating process. So I've created a screener of my own, and it's called Naked Puts. And I just want to show you some of the inputs here. Now, if you're interested in this will be included in the slides with the recording of this video, so you can come back and look at this as many times. You don't have to rush to take a screenshot. So some of the things that I added, and again, if you not know how to create a screener, we do have tutorials on that, and there is a lot of information that you can bring in to the screener, especially options, information, for instance, that break-even probability, our break-even price, our potential return, and all those elements that we just kind of went over. But first one I'm going to do is I want to know what our bar chart overall opinion is. Again, those technical indicators over those multiple timeframes. And I only want to look for those that have a buy or positive indication. Again, I want to look for those stocks that are trending higher. That potential return, remember I said that we want to be in that 1 to 2%. So here I'm just using 1.5%. Applied strike volatility, what did I say? This is where my sweet spot, and this is 50% to 100%. But I will tell you that I do find some good trades where, the implied volatility is, in the 30s or in the 40s. Just where I'm starting from. And again, once I have this already set and designed, then I can make, small tweaks and adjustments. Again, days to expirations, I want to have enough time to give somebody the chance or the belief that their put is valuable. That might mean more than 30 or 40 days, but also I like that decay fact. So I want to see those ones that are starting to get the thetas are starting to rise. And again, I'm more likely to trade monthly expirations than I am weekly expirations, because I just know the institutions tend to trade more volume and more open interest in those. And then, I don't really change the volume. And then the only other thing that I do here at the bottom is I added at the money, because I might be looking for opportunities in terms of entries at discounts, and then my bid price. So the default is 5 cents. I just make it 50 cents. Again, this is not a criticism. I just know that there are a lot of traders who do look for, so let's say weekly trades, these naked put trades. Well, you could find a weekly with 3 days expiration where you might get 10 cents or 20 cents. And I know there's a lot of traders that make a lot of money doing this. It's just not my game, right? I want to make sure that I get, that greater value and a greater return. And also, this is kind of just a threshold that I use. And so once I do that result, now that 665 is now down to 39. And so the first one that I see that's kind of really jumps out to me is Coin. Now, if you're not familiar with this stock, this is Coinbase. There's a lot of news around it based on a potential Bitcoin ETF, and that BlackRock is going to use them as their custodian. And so this stock has really been ripping lately. It's been on the move. So, maybe this would be a great way to get into, let's say, the crypto space. I'm going to trade a equity that's, I'm not buying a crypto, but here I could do some type of naked put strategies. So the first one I see here that I really kind of jumps out at me is here is Carolina today is trading $86, and here's the $75 strike, and my moneyness is 12.9, so it's outside that 10%. So that probably tell me this is going to be more like an income trade. And my delta here is maybe a little bit on the high side. Here's 0.26. Maybe I want to get a delta that's a little bit lower. So bear with me for a second here. But again, what is my potential return? Well, it's 7.3%. So now I know that coin is one of the ones that I might be interested in. Now, maybe I like this trade and maybe I'm waiting for a better opportunity. So what I could do is come over here and under the three dots here, I can add options to a watch list. And I can come and click that on. And I do happen to have a watch list of naked put options. So I'm just going to add that. Oh, I think my clicker has died. Some days, Gene. Let's try this again. There we go. And here is that watch list. So I just added it. So what I can do is I can collect a lot of these different put combinations that I like, or maybe I'm waiting for a better a price or a better return or a better break even. Now, at any time of our watch lists, we can create a custom view. And now, if you're not familiar, again, there are tutorials how to do this. And I do have a custom view of my own. Here's naked puts. And again, what I might be looking for is, a certain moneyness or distance from the strike price. This percentage of stock price to bid stock price is very similar to our potential return. We remember the potential return is that discounted the bid minus the stock price. Here's just the stock price. But I can use this as kind of a measuring stick. And then again, my days to expiration, my delta, and my theta, and my implied volatility. And if you're not familiar with custom views, I just want to show you here under the custom view tools section, here's our naked puts. And those are those inputs that I just had. Again, these are just kind of ones that I just played with. But here's a lot of different categories that you can use. And these are you can use in multiple markets, and these are general categories. But there are some that are custom, that are specific to options, just like I showed you on the filters side. And again, you can add some very specific options analysis or options information into your custom screener. Okay. So let's go back to that watch list and that naked put. And so one of the ones that I've been watching here is this $60 put. And again, let's just go to that, click on that, and so here's the $60 put that we did on the naked put. Now the 75 we said was, maybe that was a little too close for comfort in terms of our moneyness. But here you can see the $60 put is 30% away from current price. So a lot more unlikely that price is going to go down to there. Now, the prices have changed a little bit this morning, but you still could take in $1.50 here, and that's going to give me a break even around $58.46. And I'm going to get a return of 2.6. This is more realistic, right? Some of those ones that have super high volatilities, or ones that are at the top of our ranking list in terms of a naked put page, those ones might be, I would say we might be a little bit more cautionary. But here's a reality. This is what you really kind of want to look for. Here's one for 37 days, I'm going to get 2.6%. That's what you're going to find a lot more of than those 7, 8, 9%, which you can see the closer I move to current price, I'm going to get a greater return, but also I'm taking on a greater risk. Now, one of the things that I do like to do with this particular strategy is I will come into the put call ratio. And what I want to do is, now today Carvana is up 4%. So this is not going to give me a great example of it, but what I'm going to show you this in a later example, is what I'll do is I'll come in here, and what I want to look for is that volume to puts to calls. And again, remember, when we see volume in puts, that probably an indication that somebody is buying a lot of, or buying puts. Now, typically you'll see this at down days, but you do see that the put call ratio, if we look at that, I want to look for put call ratios that are above 1, that parity of put to calls. Now, normally what you'll see is there's usually more calls trade, so you'll be in that 40 to 70% or that 0.4 to 0.7%, and you can kind of see that here. But for this particular expiration, we do see that there's a lot more put activity. And if I go into that, then what I want to do is I want to kind of look for those puts that are more active. That will tell me which is the ones that are probably more trading, again, potentially for greater premium inflation. And, again, that $60 put today, about 1,000 lots traded on 6,000 open interest. That's a good ratio for me. And that would probably be, for today, it looks like there's still value in this particular trade. All right, so let's move on to, let's go back to our naked puts. And coin is, did we just do the coin one? Yes. So let's go back to the coin one. I think we just did Carvana, right? So here's we have the $75 strike on the coin and that $5 premium. Again, what I just showed you is we're looking for that technical support, right? So we just did the $60 put. So where are our 50 days, 100-day, 200-day moving averages, right? Down around the $60. So this is giving me more of an onus to saying, hey, listen, I believe that this would be a better trade for an income trade because I don't think price is going to move down there. All right. Now, the other thing that I do is a lot of times if I have a set of stocks that I'm interested in buying, or I've been keeping an eye on that have been trending well and I want to jump into them, but I don't want to chase price, I'll create a watch list from there. And so here I have one that's called Put Me in Coach. Now, these are the ones that I'm going to look for those opportunities where I'm going to be more at the money and I want to get that bigger discount. And so the one that really was interesting for me today was AI. And again, we can talk about, all the hype that's been around AI, not necessarily the stock, but the category of artificial intelligence. And here is that example that I was showing you. So today you can see that AI is down 3%, right? So anybody who's bought AI, there might be a little fear in them, right? And so what would they do if they had fear? Well, they're going to buy puts. So if I go to my naked put, let's go to our put call ratio, right? And again, I'm going to look and see where I see a high put call ratio in terms of volume. And you can see for the September 15 monthlies, there has been 3,300 volume traded so far today. So that tells me that, that these traders are looking to protect themselves by buying puts all the way out to September 2000, September 15, 2023. So I'll go to the puts, and where is that volume? Well, that volume is at $40. That's my current price, $40. So let's go to our naked puts. There is a $40 current price that's only 1.3% away from current price. Low moneyness, right? That's telling us that this is going to be an acquisition candidate. What's my delta? It's above 35. Again, another acquisition candidate, right? But what am I going to take in? I'm going to take in $7.35. So what is that in terms of my potential return? $22, excuse me, 22%. Remember, if I'm doing an acquisition trade, this is the discount that I'm going to get. So if I did this trade, I sold these puts today, and I was willing to hold, I'm willing to buy AI at $40 from now until September. If I get exercise between now and September, I'm going to be discounted 22%. In other words, my break even will only be $32.65. All right. Let's go back to list some of the things that we learned. Technical analysis. What's my 20-day moving average? $39. Right in line where my discounted value is. Where's my chart? Here's my 50-day moving average, 32.25. Where's my area of where I believe that there is support? This structure, right? Right in here, around $33. Let's go back to the put. That September put. That $40 put. My break even is right at my 50-day moving average, right in an area of structure. And if I do get exercise between now and September, right, and on that $40 put, I'm really actually buying the stock at $32.70, and I'm getting the $22, 22% discount. So this is a way we can enter into purchasing a stock, even that though today I'm buying at the money, the put, or trading the put, selling the put at the money, I'm getting a nice discount here. The only thing that I have to do now is risk time and what could happen in AI between now and September. Again, if I use proper risk management and I do get exercise, maybe if this stock starts falling precipitously, maybe I would use, a stop, maybe around, $34 or $33 before I got to my break even. Okay, so I hope you guys like that. I went through a lot of material here, and then again, I'll remind you that all of our videos are recorded, so you can watch this over and over. So, Janie, let me take a moment here. I see you sent through some questions to me. Let me see if I can answer some of these.
Okay, and while you review the questions I sent you, John, I just want to remind everybody that the Naked Put Screener is part of the Barchart Premier membership. If you have not tried Premier yet, or even if you have and it was a while ago and you want to explore Naked Puts a little bit more, we do offer a free 30-day trial, no obligation. So go ahead, sign up for a trial. You can check it out and you can start putting to practice some of the things that you've learned today from John.
All right, so let's just jump right to one of the first ones here. David asks, okay, with coin earnings date of August 9th, is it worth the risk of selling the 8, 9, 818 naked put. And yes, that is a risk that we need to be aware of, that I need to look at earnings dates that could be a catalyst for moving the stock. Now, what could happen between now and then, David, is that volatility might come down a little bit, or the stock price will stay right where it is now. And by the time the earnings date rolls around, maybe I would, exit that trade. I'm not looking to capture that whole premium. Maybe I'll capture 60% or 70%. So yeah, sometimes, David, what I'll do is I might put these trades on, and especially these ones that are a little bit longer dated. And if I do have one of these catalysts that could disrupt my stock price, then I might exit that trade prior to the earnings. In this particular example. So Scott asked a question about moneyness, and so again, moneyness is really the distance that the current price is from the strike price. And so, Scott, right here, you can kind of see this, right? Red means that the strike price is below the current price, right? Here's a $40 strike versus a $40.16. And it just tells us in a percentage what is the difference between the two. Green just means it's above. As far as how we look for that, again, if I'm an income trader, I want to be a little bit outside of 10%. If I'm an acquisition trader, I probably want to be inside of 10%. I'm getting a question about AMC, and again, I kind of think, I looked at this morning. So first of all, AMC, implied volatility is off the roof. What did I say? Volatility is good for us because it's going to increase premiums. But when you get like these super inflated implied volatilities, it's just a lot of risk, right? So, trader beware on this one. Yeah, there's some great premiums here, but think of it like this. Why are these premiums super high? Well, because the bids or asks need to rise in order to get somebody to sell these, right? So that is telling me that there's a lot of risk in this trade, that, maybe tomorrow we wake up and AMC is a zero stock. Now, if you're willing to, risk a $4 stock where you're going to take in $1.50, right? I mean, that's a good ratio, right? It's like 2 to 1. I mean, then go for it. But again, I think in terms of the way the put strategy is set up, the naked put strategies, we kind of want to look for stocks that are trending higher, right, or having a greater probability of success. And certainly AMC, you can see here, it does not look like a good candidate for a naked put strategy. Okay. All right, so Richard's asking, when it comes to selling puts for income and it comes down to close to the strike, would you prefer to buy to close, roll out, or get assigned? Well, that's a great question, Richard. So I think if I design the trade as an income trade, I probably will close the trade out. Again, I rarely take a naked put position to expiration unless it's so far away, right? But you're saying it's coming closer to our strike price. So if I can capture, 85, 80% of that original credit, hey, I'm going to ring the register and run on that one. But there are instances that I will put the trade on as an income trade and not thinking there was any chance for it to come to me. And now prices come back. Well, at that point, if that's a stock I'm still interested in, I will do that technical analysis. Do I feel that they were coming into an area of support? Are we on a moving average? Are we in an area of structure? Is this a retest of an area where we broke out? A former area of resistance has now become support. So if those kind of things start adding up, then yeah, maybe I'll take my chance on seeing if I can get exercise, because I know that I'm going to get into this at a discount. The only problem is if I'm doing an income trade where I'm only getting 2% or 1.5%, on the original trade, that's not a really good discount for me. But if I put on an income trade where I'm got, 4 or 5%, then that would still be a good discount for me. Okay, Richard. So keep that in mind, all right? So Randall asks, what was the maximum DT would you consider? I kind of want to stay in that somewhere around 60 days or less. Remember, because we're really kind of doing a credit trade here. We want theta to be our friend. But again, if I feel like this is a stock that I really like, and I feel that that trend is going to continue for a number of days or weeks, or in this case, maybe 2 or 3 months, then I'll go out. I don't really go too farther out than that. So I would say my sweet spot is probably in that 25 to 45 is where I'm kind of look where I find a lot of these trades. And then Randall follows up, of course, with the delta. Randall, we talk about the delta again, below 25 or 20 for income, and probably around that 35 for acquisition. Okay. All right, so we're at the top of the hour. If I didn't answer your questions, send them to support@barchart.com. We'll get to your questions. I apologize if I didn't get to everybody's questions. I do see a lot of great questions are coming in here in the last little bit here, so I apologize I don't get to that. So let's do this real quickly. Is a couple takeaways for you. So first of all, takeaways for income generation. Again, remember that out of the money strikes provide lower probability of being exercised, but they also lower the credit premiums. So moneyness at or greater than negative 10%. So that should help you a little bit. I think that was Scott's question. Potential return, again, we want to look in that 1 to 2% range for every 30 days to expiration. Again, if I'm looking at this in terms of an annualized, if I'm on a weekly, let's say I'm on a weekly and I'm inside of, let's say, 3 or 4 days before expiration, then look at the annualized and look for an annualized somewhere between 12 and 24%. Looking for timing opportunities when volatility is high. I didn't go into this a little bit today, but look at your ranks and your percentiles in terms of your implied volatilities, that relativeness. Another thing that I kind of do is, when the broader market is a little jittery, right? When the VIX gets elevated, that's usually a good time to start hunting for, naked puts. But the one that is kind of my bread and butter is look for that put volume activity in certain expirations, in certain strikes, because that is probably where there's a little premium, a little extra premium, and then set those trades up accordingly. And then again, if I'm doing an income trade, I want to make sure that my break-even price should have some time of technical support, either moving average or structure, or how you defined it. If I'm using the naked put strategy for discounting entries, again, remember, we're trying to purchase a stock at a lower price than today's market price. And that at the money or in the money strikes will provide both higher probability that we're going to get exercised, but also going to give us those higher premiums. Again, there's a cautionary tale about how much time we want to give and other things that we need to be aware of, like earnings, like one of the questions we got. But again, when we start to do that analysis, we want to look at potential return as our discount coupon, that value. How much am I going to get as a discount to take that risk on? Now, so what you might discover sometimes is you will put one of these trades on, and next thing you know, boom, the stock price goes up even higher. And yes, you didn't get to buy that stock. But that discount that you got, let's say we got a 10% discount because the put expired worthless. Well, the next time I get a buying opportunity in that stock, maybe not through the options where I feel comfortable buying that stock, I know that in my back pocket, I have this 10% discount that I've already banked. And so that I can use that as, kind of a way of saying, hey, here's a $60 stock that I'm willing to buy today. Well, the last time I traded this as an option, I made $5. Well, or $6. So I can buy the stock at $60, but it really, because I made money before, I'm really buying the stock at $54. And again, using timing opportunities in our ranks, our percentiles, our VIX, and our options activity. And again, using break even and technical support. All right. So just a reminder that all of our videos are on our webpage under recordings, under our archives. This one will come up later today. Gene will put that up for us. And if you want those slides or those snapshots of my slides and the snapshots of that screener, you can find it there. And for next week, we're going to break down our market opinion page, which I kind of showed you what you use that for our strategy here. And we're going to look at the strength and direction in terms of helping us decipher trend analysis or trend strategies. So I think you might enjoy that. And so hopefully come back and check us out. Gene, did I forget anything else?
No, I think that's it. You'll get an email a little bit later on this afternoon with a link to the recording. And actually, if you go to well, John, you've been to the archived webinars page. The recording is going to appear over there and on our YouTube channel.
All right, Gene. Well, I'll talk to you in a couple of weeks, and then not next week, but everybody out there, be safe out there. Manage your risk well, and the good of all trading.